Overall, folks, Wellington values actually softened again in May, but everything else is pointing to the market firming, and I maintain my caution to buyers is that if you're a buyer and you're waiting for things to get better, then I think you might be disappointed they're going to get harder, or at least there's a greater chance that things get harder rather than easier. So someone's just posted a chat here. New haircut looks good, Adam. Thank you very much, TS. That means a lot to me. It's not that new, actually. It's about a month old or something. But anyway, that means at least you can see me. So that's positive. All right, let's get into it. Median sale price, May 2023, $795 versus $900 a year ago. That's down 12%. 12% is a smaller decrease on an annual basis than we have seen for some time, and you can quite clearly see the pattern of things there in the blue chart. Just let Brenda in. The blue chart, you can see there that we hit just over 800,000 back in July 2022, and we've been bouncing around 800 since. So this is May data. So July was only 10 months ago, or was 10 months ago rather, and we haven't really changed much since. Bit down, a bit up, and so on. But for the last 10 months, median sale prices have been broadly flat. So in a couple of months' time, it'll be interesting to see if we're still bouncing around 800. We will have changed very little on an annual basis from the median sale price perspective. As you will know, if you kind of check into these meetings or if you watch my videos, I don't pay much attention to the median sale price because it reflects just as much the mix of properties sold as the underlying values. And of course, it's the underlying values that we are most interested in, not the mix of properties sold. So the Real Estate Institute House Price Index is the one to look at for that. And here's the overall chart summarizing sort of the state of the nation. So you'll see there the parts I've circled there. Across the country, we have seen values fall about 18% from the peak, which is October, November 2021. Auckland has seen just over 23% drop, and in Wellington, and of course this is the region, Wellington region, we've seen now 26% drop. That's after this most recent month in May, seeing a 1.4% drop. And again, we've seen a deterioration similarly in the 3-month result of minus 4.3%. This is quite substantial falls again. But again, if we look in a moment, and we will look at the overall pattern of things, I still maintain that we're seeing reasonable stability. And you'll see there that 15%, and not only is 26% leading the charge, whoopsie daisy. Sorry, guys. Don't know how that happened. Anyway, 26% leading the charge since the drop. We're still a greater drop than anywhere else in the country on an annual basis as well. But you'll see soon that the rest of the country is kind of catching up in that a little bit. Here we can see the shape of things over the last 2 years or so. The blue line shows you the monthly house price index change for the Wellington region, and the orange line is the 3-monthly. So clearly you can see things were at their worst in sort of May 2022 here. Since then, the degree to which prices or values are falling has been easing back towards parity, back towards zero. We nearly got there in November 2022. Then we suffered a couple of months of buyers pulling back from the market again after a couple of bearish announcements and results in terms of inflation and the Reserve Bank announcements talking about we're going to have to crush the economy, we're going to have to go into recession. We now have, it's been confirmed, of course, that we were in recession in the quarters of Q4 and Q1 this year. Then we've recovered almost back to parity again up to April, and then this last result has pushed us back down again. Is this a blip, or is it a new trend? The rest of the data to me is indicating this is more likely to be a blip than a trend, but of course predicting these things is exceptionally difficult. You can see there that Wellington City has had a pretty bad month in May, down 3% in the month and nearly 6% in 3 months. Again, the smaller you go in terms of territorial authorities and the shorter the time frame, the less reliable the data gets, or the more it bounces around. So for that reason, I tend to prefer 3-month results than the 1-month results, and I tend to prefer the Wellington region to the Wellington city or any other territorial authority. So yeah, I mean, you can see there clearly the trend is we're heading back towards parity, but we have had recent deterioration in the month of May, just most recently. So in terms of new listings coming to the market, the blue line, of course, is the monthly results, and the red line is the 6-month moving average. I'm sorry about that, folks. My mouse seems to be very sensitive, and we seem to be going backwards. You can see there the red line, 6-month moving average. That trend is absolutely stark and clear. We did see an increase in the number of new listings coming to the market kind of towards the end of the peak of the market, which was late 2021. And since sort of early-ish 2022, we've seen a clear trend of listings pulling right back again. So the way I'm expressing this overall is that vendors are on strike. They're simply saying prices are now too low. I'm not interested in selling for those prices. I haven't lost my job. I've had pay increases. Yes, cost of living is going up and all the rest of it, but I'm not under sufficient pressure that I'm forced to sell at these low prices. Sorry again. So in May this year, this most recent month, 458 listings came to the market versus 675 a year ago and 622 2 years ago. So this is very clear, a third down on a year ago, a quarter down on 2 years ago. And yeah, the shape of things is absolutely clear. In fact, over the last 6 months, on average, we've seen 474 listings per month, and that is even lower, even fewer listings than we saw in the 6 months to September 2020, which incorporated, of course, several extended periods of nationwide lockdown and the caution that resulted in the market immediately prior and immediately after lockdown. After that, of course, it shot up again in terms of listings coming to the market and indeed buyers transacting. But yeah, even fewer listings coming to the market over the last 6 months than we saw in that period in 2020 when we were in lockdown. So this really is sellers going on strike severely. There you see that's the average number of listings coming to the market in May, in the months of May, going back to 2015. So 660, and we're at 458, sorry, in the last month. So approximately 1/3 down compared to the average. So pretty extreme result. And here we see it depicted as a function of the change versus the same month a year ago. So this fact that we've seen these blue lines significantly down below the x-axis since September 2022, significantly and consistently, this is what I'm saying. This is showing us that sellers have been on strike. We saw more listings coming to the market on average since kind of late 2020, with one exception in August, July and August kind of thing, 2021. Overall, in more instances, more listings coming to the market, but since sort of late-ish last year, we've seen, as I say, the vendors have gone on strike. On the other side of things, this is the number of sales taking place. Similarly, we can see that the number of sales taking place has been consistently reducing. However, the degree to which they're reducing, or really, it really got arrested from June, July last year. Since then, we have been tracking on a 6-month moving average at about the same level, which is in around the 500 mark. So on average, that is. So 653 in May this year versus 524 May last year, 735 May 2 years ago. So we actually see here quite a significant increase on the same month last year, 25% up, still 11% down on 2 years ago. And we can see there, if we look at what is the average number of sales in May, since May 2015, 732. So 653 last month versus the average of 732. We're still 10% down, but that is not as far down as we saw in terms of the number of listings coming to the market. So buyers and sellers have been on strike to a certain degree, but the buyers have been becoming less on strike, if you like, and returning, sort of heading back towards a more normal level of transactions. But the sellers continue to be on strike. Now, of course, if that dynamic continues, then we will see, and we already have started to see, buyers reconsidering at stock that has been on the market some time, because there's not enough new listings coming on, and the decent ones are selling. Buyers are having to look at the old stock and clearing some of the old stock of the better quality. And we'll get onto that in a minute. So we're still down compared to a normal May, but the other thing to consider is that, of course, the number of deals that get done will always be constrained to a certain degree by the amount of listings coming on. Buyers are always naturally way more interested in the new listings than they are in the old listings. They've already looked at those. They've decided they're not interested. They are, as I say before, now starting to get forced to reconsider some of those. But there is naturally a constraint on the number of deals that can get done, depending on how much is coming to the market. So you see there that the number of sales, just to summarize, the number of sales there has been kind of flatlining on a 6-month moving average basis. And more recently, we can see there's a general trend upwards in the last 4 months or so. And this May is quite a strong result. And this next graph shows that very clearly. Since July 2021 here, since June 2021 here, we've seen the number of sales taking place less than the same month 12 months prior, with one exception being January 2022. And Januaries are typically an unusual month. They're lower in volume of sales, and so they can bounce around a bit. They can be a bit weird. So I wouldn't base your predictions too much on what happens in Januaries. But with that exception, every single month has been fewer sales taking place than the 12 months prior, until last month. In May 2023, where we saw a significant increase at 25%. So we have not seen that sort of thing since, strangely enough, May 2021, exactly 2 years ago, with, as I say, that one exception, January 2022. So this is a significant turnaround. Again, one data point only, 1 month only. Does that mean we're going to see the same thing next month? Not necessarily, but the overall trend there is also clear. You can see those blue bar charts trending up towards zero, and this one has pushed back through zero into significant positive territory. Incidentally, we are seeing that on the ground. Where I work, obviously at Lowe & Co, we've seen significant increases in open home traffic, for example. And so that, and also number of offers getting made per property. A year ago, we were seeing sort of 3-4 groups at open homes on average. I think from memory, in June to date, on average, we're seeing almost 8 groups at an open home. So it's about double what we were seeing sort of a year ago. And there, the data is confirming that again, that we're significantly ahead on the sales volume in May than we saw a year ago. How long is it taking to sell? Look, it's still taking, it's still kind of sluggish. Things are not moving quickly. Buyers are not losing their cool. There are more buyers out there. There are more deals getting done, but buyers are still rational. So on average, you can see there that we've been sticking around the early to mid 50s days on average over the last 8 to 10 months or so. We saw it dropping off. Then, as I said before, the two scary announcements around inflation and the Reserve Bank's announcements scared buyers away. It then took longer to sell again, and we've come back down again. So the last 3 months, we've seen it around the 49, sort of to 55 day sort of duration. So not quite 2 months. So 54 days in May versus 55 in May last year and 24 May 2021. So it's still taking a reasonably longish time to sell property, but certainly we are past the peaks that we saw a few months ago, sort of at the start of the year, and similarly the peaks that we saw middle of last year as well. Inventory, 14 weeks worth of inventory versus 20 a year ago. So that's a significant decrease, and versus 5 2 years ago. So clearly you can see 2 years ago, we were in this territory here, very, very low levels of inventory indeed. Interestingly, at 14 weeks, significantly down on 20 weeks of a year ago, 14 weeks is exactly the long-term average for the amount of inventory in the Wellington marketplace. So on this metric alone, at least, you could say that we are in exactly a normal balanced market. So again, and you can see the shape of that graph there. Again, that is suggesting we are returning back towards tighter market, rather things getting better for sellers, things getting worse for buyers, rather than the other way around. Gross number of listings on TradeMe. Overall, again, you can see that red line has been plateauing roughly over the last sort of 12 months or so. We peaked there in early-ish 2022. It's been leveling off since then. Obviously, we get seasonal variations. Interestingly, this is quite a significant drop-off we've seen over the last couple of months, from April, May to June. As of a couple of days ago, 2,253 listings versus 2,828 a year ago, a drop of 20%. So over the last couple of months, we've been seeing reductions in the number of listings on TradeMe compared to 12 months prior. And that the level at which it's been reduced has been increasing. And there it is there in a different graphical form. So you can see as of about June, July, we peaked at the level of increase compared to 12 months prior. We peaked at 160% more listings than 12 months prior. We've seen significant and rapid drop-off on that metric. And as I said before, in the last 3 months, we've seen fewer listings than 12 months prior, leading to, for the first time in quite some while, since it's been since June 2021 since we've seen this sort of level of change at 20% down compared to a year ago. Sorry. How do I do this? There we go. Yeah, so in summary, Wellington values have been broadly stable for a number of months now, but they have declined, showing fresh softness again in May. Personally, I think all of the data suggests that's a one-off rather than a trend, but by no means my crystal ball is not clear. New listing volumes have been consistently low since September 2022, and they remain at consistently low levels. That has not really been changing ever since then. We're sort of seeing 25 to 40% reduction versus 12 months ago. Sales volumes is recovering on a relative basis. It is still less than, or it has typically been less than 12 months prior, but in May we pushed up, so we're actually 25% more than last May for the first time in about 2 years. Duration to sell has been long but stable and down on recent peaks. Inventory remains at normal levels for Wellington. TradeMe listings are 20% lower than a year ago, which is continuing that theme of reducing there. Wellington's values were soft in May, but everything else points to a gradually firming market. Buyers do not wait for things to get better. Sellers, good news if your property is well presented, well located, and properly priced. And we are certainly seeing that buyers are hyper price sensitive, more so than in a normal or a booming market. So pricing is absolutely critical to attract a lot of interest and get a good result. But certainly things are improving for sellers out there. So look, I've got some other data here, mainly all from Tony Alexander's premium newsletters over the last few weeks. So appreciate that info. Thanks, Tony. Generally, this is my interpretation, buyer sentiment is improving. So this first one on the left here is responses for, is it a good time to buy a house? So for a number of months now, we've had, on balance, more people saying, no, it is definitely not a good time to buy a house. The last few months, we've had a balance between people saying no and yes. So that's certainly indicative that buyer sentiment is improving. This is a survey of the real estate agents around the country. More or fewer people showing up at open homes. So it's been broadly neutral for a number of months now. And for the first time in a long time, we've seen a gross on balance 30% roughly. Agents reporting, yes, definitely more people showing up at open homes. First home buyers coming back. This is again the real estate agent survey. So more or fewer first home buyers in the market. A big jump upwards in May with agents reporting, net reporting, yes, definitely more first home buyers in the market. Finance and interest rates. So this is the mortgage brokers survey. Are lenders more willing to advance funds? Yes, in the recent months, they have been more willing to advance funds. My interpretation of this is it's still tough, just not as tough as it has been. And of course, we're seeing the banks relaxing the low deposit lending, able to lend 15%. I think it comes in on the 1st of July, 15% of lending to buyers with less than 20% deposit. And 2-year fixed mortgage rate there, you can see it's peaked and seems to be coming down. Net migration, and this is an interesting story. Over the last month, we've started to see headlines actually catch on to this, that net migration is booming again. Previously, even though it was clear it was booming, the headlines were not focusing on that. They were focusing on Kiwis leaving to Australia, and that is right, net Kiwis. We are losing net Kiwis, but we are gaining way more net immigrants. And so on balance, I think it's the 12 months to the end of April, 73,000 net inbound. And so that, of course, with a population of about 5 million, 73,000 is about a 1.5% population increase just from net migration, which is enormous. And you can see the graph here. This annual number is higher than any time since records started in 1961. With one exception, when the government announced in 2020 we're closing the borders, and people quickly flooded back into the country to avoid being locked out, and then it plummeted, of course. So that's extreme numbers indeed. But interestingly, here at the graph on the right here, you would have seen perhaps some headlines saying people are predicting perhaps we might hit 100,000, which would be unprecedented. But that's based on 2 very strong monthly results in February and March. And in April, we saw a significant drop off from there. So that suggests perhaps this is not a theme. It's more migration catching up with pent-up demand that was suppressed due to lockdowns. And so Tony Alexander's view is that he's predicting that perhaps annual migration might settle at around 60,000 as opposed to the 100,000 that the extremists were suggesting. So a couple of comments here. Yeah, Peter, you're welcome for the data. Who do you see more in open home nowadays? First home buyers or investors? Without a shadow of a doubt, TS, whatever your initials stand for, without a shadow of a doubt, first home buyers. There are no investors looking to buy. No, almost none. I did have a chat though the other day to Andrew Perry, the mortgage broker, of course, Tushar, thanks. He's suggested that there are a little more inquiry coming from from investors. They tend to be younger investors, sort of upwardly mobile people. They might have their own first home and they're looking to buy their first investment property, got good income, good savings, and they're wanting to buy new townhouses, that sort of thing. But my experience and that of my colleagues as well, you ask any of my colleagues at Low & Co, they'll all say there are no investors in the market. Not there are fewer, there are none, basically. Whereas first home buyers, there are heaps out there. They are really coming out of the woodwork. In fact, I had a rather extreme example. I sold a place about 2 weeks ago, a little place on Island Bay, very nicely presented. I priced it very conservatively to make sure that if we were going to err on, I mean, when you price a property, you're going to get it wrong. It's either going to be too low or too high. You're not going to get it perfect. And so we prefer to err on the side of BEO that's a little on the too low side, because if it's too low, what it does is it attract a ton of interest, and then the market will push the price up to where it should be. And indeed, that's what happened. I got in this little cute place in 16 days. I got 132 inspections, 13 offers on tender day. Now that, of course, is the exception to the norm. It doesn't go that way normally, but that's extreme. but it does show how many first home buyers were out there in the market. So we had 13 offers. That's 12 first home buyers that were ready to buy something, and they missed out, so they're still out there in the market. So yeah, first home buyers are 100% back, and investors are very much still absent. So yeah, thanks for that question, and good question. And in fact, we'll see a little bit of that here in some of these graphs. So building consents, we know building consents have been dropping. We see that there, it's fallen off a cliff. That's a huge increase in building consents. It's really tailing off now. This next graph just came out in Tony's recent newsletter last week in his premium newsletter. And this is interesting, showing that building consents trail sale volumes. So sale volumes go up, building consents go up. Sale volumes come down, building consents go down. And this makes sense because the developers become very cautious. Even someone looking to build a new house for themselves, sales volumes are coming down. If prices are softening, people get worried about, how much will my house be worth? The developers are worried about how much can I sell these things for, so they pull back. And also the banks withhold lending. What we see here is rather interesting. So for the first time since 1994, where this graph goes back to, we see building consents crossing over the graph of sales volumes. And so this suggests to me that if that historical relationship is going to continue and is maintained, building consents have got a massive distance to fall. So will we see that? Only time will tell, but it certainly suggests that there's potential for building consents to fall an extremely long way from here, which of course would not be good news for builders and people in the construction industry out there. Interestingly, these two surveys indicate that perhaps investors are slightly less pessimistic, still pessimistic overall and sluggish, but less pessimistic. Are you noticing more or fewer investors in the market? This is the real estate survey. The most recent result in May, still fewer, but fewer by less, not fewer by a less extreme degree. Of course, if it's been consistently fewer and fewer and fewer and fewer for 24 months, like you have seen here, that's extreme. So still fewer, but maybe leveling off at that lower level, lower numbers. But this is interesting. This is the survey of mortgage advisors. This is saying with mortgage advisors, like I said, Andrew Perry said to me the other day, we're actually starting to see a small increase in the number of investors seeking advice. So again, Tusha, building consents reducing means low inventory in the market, pumping the price. Well, low inventory doesn't pump the price, but it certainly constrains available supply. And yes, when demand returns, that will pump the price for sure. Jeff, are you seeing many investors selling off their investment properties? Another good question. And so far, we haven't historically seen a great wave of investors coming to the market. There are always investors selling, of course, but has there been a significant increase? I have not noticed it. I actually ran the training at Low & Co this morning, running through all this data for my colleagues, and the feedback from them for the most part is no, they are not seeing more investors coming to the market either. They're not getting more inquiries from investors looking to sell. There was one or two agents who were saying, yes, they are getting more inquiries, but when I asked them, they are talking about one vendor or two vendors. And so one vendor might be, asking them to appraise 3 properties. That is not necessarily a trend. So we're yet to see that, Jeff. But it's a good question, and I have got a couple of more bits of feedback from Tony's surveys coming up here. We just saw that, and vendors less pessimistic. But this is the couple of graphs that came out just today in the was it the investors survey with or the investors survey, was it with Crockers maybe? Yes, it is, as it says here, Crockers and Tony Alexander. So this is one is the net percentage of investors planning to purchase a property. So we've seen overall, even since the government made their announcement regarding the change in tax rules, there have still been, on balance, a positive small net proportion of investors looking to buy. until the last 3 months when it has significantly deteriorated. So on average, only in recent months have investors on balance been thinking, no, this is a negative result to I'm going to buy, which means it's a net result of I'm intending to sell. So that's interesting, and this might be, of course, because we are now into the phase where only 50% of mortgage interest is tax deductible, and soon it'll be, well, next year it'll be 25% tax deductible, and so perhaps investors are really starting to see this coming through, and they're getting squeezed by that change in the tax rules. And this is a response to the question, are you contemplating selling because of the tax deductibility changes specifically? It's been a reasonably sort of a consistent result overall until the last 3 months, where we've seen a reasonable trend there of an increase in investors saying, yes, I'm planning to sell specifically because of the change in the tax rules. So this is tax starting to bite. So maybe we will see. I mean, and I suspect it would be logical, wouldn't it, that if we don't get a change of government later in the year, obviously use your vote wisely, folks, then investors, if they're already thinking of selling because of the change in the tax deductibility rules, and they have confront another 3 years of things getting worse on that front, then that may well increase investors' propensity to sell, bringing a lot of investment grade property to the market, which of course would be damaging, in all likelihood, be damaging to the value of investment grade property. And certainly we have seen on the sales front, investment grade property has suffered more than owner-occupier stuff. So if you're an investor and you own stock that could be pitched to owner-occupiers, then you are less impacted in terms of your ability to sell if you desire to, than if you own a block of, or a villa converted into 3 scruffy flats. That sort of property is only able to be sold to an investor, really. No owner-occupier wants to buy that sort of property. In fact, even decent home and income properties are proving much harder to sell. Your average buyer just wants a typical home with no privacy issues, no flat attached or anything like that. Even those properties are less popular than we've seen traditionally. So yeah, investment grade property is cheap. Much cheap. The prices have suffered, and I haven't done any data on this, but my experience is that those prices have suffered significantly more than real estate overall. Just a reminder, Wellington City values are very, very defensive now, very, very good value compared to where the long-term trend of Wellington City values sits compared to New Zealand overall. On this basis, we're about 15% underpriced in Wellington City. Inflation seems to have peaked. Labour market remains tight. So that's everything, folks. If you have anything else, if you want to ask a question or anything, let's see, there might have been nothing else in the chat. Now's the time to jump in if you want to ask something, have a discussion. Don't be shy, sing out.
You mentioned like there are no investors in the market, and looking at a lot of properties, good investment properties. What's the reason you think that investors are not looking at creatively turning a new old build into a new build and taking advantage of these situations?
Sorry, so your question is, why are investors not taking advantage of taking an old property and turning it into a new property?
Yeah, like say, for example, chopping a house into 2, or there are certain exemptions where a person can change, or like they can change. Like I've done a renovation where I haven't used that thing, but I've renovated like majority of the property, so it's actually a new build. It was inhabitable. So if I would have gone through a consent process, it would be termed as a new build with a new code of compliance. Do you reckon like why investors are not taking that approach or thinking more out of the box when things are ready?
Okay. So I mean, obviously I don't know for sure because we don't have that sort of information, but anecdotally I would suggest firstly, the vast majority of property investors are not that creative.
Oh, okay.
That, you know, the people who do that sort of things, those sorts of activities, that sort of strategy, those are the people who are really motivated to use some elbow grease and a high amount of effort to turbocharge their results. The vast majority of investors do not want to do that. They're running small businesses, they're a contractor, they've got a normal job, they got children, they got families, they're busy. They just don't have the energy or the inclination to do that. And as well as the potential for improved results, it also involves, obviously it involves time, money, stress. All of these things are obviously negative. They're not generally positive things. And you know, the most people, they don't have the bandwidth for it. They're already busy enough. And they don't want to take the risk involved or expend the effort involved for the most part. So the people who can do that, who have the bandwidth, who have the energy, who have the ability to raise the finance, who can be bothered dealing with the consent process, dealing with accounts and all that sort of stuff, and the tradespeople, you know, that's an opportunity for them for sure. I think the other thing is that those rules are actually, they're not clear. They're not that well known to a lot of investors. And even the investors who do know that there are such exceptions, they're not clear on where the boundaries of what is permitted and what isn't. And there'd be a concern, for example, okay, well, what if I go ahead and do this? And then I found out that I can't claim the interest after all. And so there's a risk around that too. So anything like this, which is a new rule, it takes a while for the boundaries of the definition to be clarified and proven. And people are naturally cautious about that. My own personal view is, you know, and I'm perhaps a reasonable example of this. You know, I've been investing 25 years. I got a number of properties, and I know that doing that sort of thing could be possible. But I also think, yeah, but it's also possible I could go ahead and do this and find the property where it's where I can execute that strategy. That's a whole lot of work. Then I've got to raise the money to actually buy the property. That's a whole lot of work. Then I've got to raise the money and go through the planning procedure to actually go ahead and execute that strategy. That's a bunch of work. And then when I've finished the property, this whole process, that might be in 18 months' time. And by then the tax rules might have changed anyway.
Yeah, that too.
You know what I mean? So
yep.
I think there are a lot of people, certainly I think that changing your investment strategy or your business strategy solely because of a new tax rule, that's risky.
So what's your point of view on the current situation now? If someone like an investor has got an ability to raise the funds, but if no one wants to do that much of work because they're busy or whatever, and they can't buy an old bill because of the interest deductibility, I wonder, like, once the elections are done and if the new government, like National or Act, whoever, do decide to change the interest deductibility rule, then it will be apparent, and then everyone would be jumping on the market to buy as much as possible or whatever they think.
Yeah, well, I mean,
is a good investment.
We're kind of crystal ball gazing here a bit, but
an investor who can invest, like, what approach one should have at this time to take advantage, like, or just wait for the. You there?
Yeah. So look, you're a bit glitchy there. But
yeah, my
let me
internet
answer what I think is the question. In terms of what will happen after the election, nobody knows, of course. But if we get a change of government and they do indeed confirm that the interest rules will change, then you have to say that investors will be encouraged to come back in the market. Will they just stampede into the market, or will they gradually come into the market? Who knows? I wouldn't assume they will stampede into the market. If, on the other hand, we don't have a change of government and the rules remain in place as they are today, you have to you have to say that will have a negative impact on investors' propensity to buy and increase their propensity to sell. Again, by how much, I don't know, but reasonably small changes around the margins can have significant impacts. In terms of what strategy should an investor engage in today, well, that entirely depends on who they are, what stage of their investment journey they're on, how much capital have they got, how much ability have they got to absorb risk. So, you know, I can't give you that, and that would only be my opinion anyway. But there are many options available, of course, to different people depending on your situation. I mean, if someone is well capitalized and has plenty of ability to borrow money at the moment and has very strong cash flow and so can absorb some temporary losses, you'd have to say there'd be a good opportunity right now to go in and buy some blue chip, you know, multi-flat properties in Mount Victoria, Mount Cook, Kelburn, whatever, and buy them quite cheaply, albeit still with negative cash flow. At least if you're borrowing money to buy them, they would be significantly negative cash flow, especially on an after-tax basis. But you would be taking the view that that cash flow will improve once the tax rules change and once rents increase and once interest rates come down again. And so I'm just buying some good quality assets today because they're super cheap. I mean, really, look, a 26% reduction in house values, nominal values, combined with, say, 12% inflation over the last 18 to 20 months or so since the market peaked, that's approaching 40% real price reductions. That's almost a cutting in half of real house prices. That's extraordinary. So someone could take a long-term view and buy that if indeed you've got deep pockets and you've got the ability to borrow and you have very strong cash flow and can wear a few years perhaps of significant cash flow losses on those properties. So it all depends on your situation, very much so.
No, thank you so much, man.
Yeah, but you know, a very interesting kind of question, and one could debate that for a very long time. If you want to discuss your situation or you want to bounce around potential strategies or whatever, then please just sing out. Happy to you know, to bash this stuff out one-on-one with your particular situation. So yeah, feel free to reach out. But otherwise, have a good night, you guys. And oh, by the way, the next month's meeting of the association should be real interesting because we've got Brooke Van Velden from ACT, and I think it's Chris Bishop from National coming to present their kind of election pitches to us and their policies and so on. So it should be real interesting. So come along to that. Be there in person, always more interesting. So I look forward to seeing you then. All right, you guys take care.